You're probably wondering, what's up with the stock market pullback today? Because the US market took a nosedive after today's economic news. Let's break down what caused the drop: a disappointing job creation report combined with 4.2% unemployment, some lackluster company earnings reports, expanding government spending, and persistent inflation. Some people are even predicting a recession. But not so fast. Let's take a deeper look. First, there is the July jobs creation report, which came in at 114,000, falling short of the 185,000 jobs previously estimated.
Oh no!
Disappointing data can have a couple of effects on the market. When job creation is lower than anticipated, it often signals that the economy might be slowing down. Investors worry that reduced job growth could lead to lower consumer spending, which impacts corporate profits. That uncertainty can cause stock prices to drop as traders adjust their expectations. Moreover, we had some uninspiring earnings reports. Quarterly earnings seasons are a decisive time for equity investors. Strong earnings reports generally boost investor confidence, while poor performance can do the opposite, creating a sell-off and a correction downward in stock price. More importantly, when companies report earnings that fall short of expectations, it can indicate trouble within the business or sector. This often results in a sell-off, as investors reassess the value of their holdings based on these new, less optimistic projections. Now, let's review the impact of increased government spending. Recently, there's been an increase to the tune of $70 billion last year, and while this might be intended to stimulate economic growth, it can also have very bad unintended consequences. Like the devaluation of the US dollar. Expanding government spending often leads to higher deficits and debt. Investors might worry about the long-term economic impacts, including potential increases in interest rates to manage the debt, which can negatively affect stock prices. Lastly, persistent inflation continues to be a painful concern. Despite various efforts to control it, inflation remains high. This affects consumer purchasing power, erodes the value of savings, and can lead to vastly increased costs for businesses, squeezing profit margins and making it harder for everyone to meet their physical needs.
Oh no!
Although the US government is likely to cut rates in September because US jobs creation has dropped significantly, high inflation worldwide also raises the likelihood that central banks will need to continue raising interest rates to keep global inflation in check. Higher interest rates can make borrowing more expensive around the world. This can slow down economic growth, which is another reason why the markets might react negatively. To recap, today's market drop is a reaction to a mix of four main factors: weaker job creation, disappointing earnings, expanding government spending, and persistent inflation. Each of these factors on its own can be unsettling for investors, and together, they create a challenging environment for the markets. If you're wondering where savvy investors are putting their assets now, watch our August 24 video series, especially Flight to Quality. Make sure to hit the like button and subscribe for more updates on financial news and analysis. Drop your questions and thoughts in the comments below. What do you think will happen next? Have you experienced this before and have some tips to share? Thanks for watching. Stay well and always manage your investment risk.